Well, hello everyone, and happy Monday. Welcome to today's weekly market check-in with myself, Greta Wall, and Derrick Oldensmith. Derrick is a professional trader with T3 Trading Group and the leader of T3 Live's Pro Desk virtual trading floor. Before we get into any market discussion, just first up, our topic today is that it is CPI week, and we are prepping with a professional trader, Derrick himself. And real quickly, here's a look at the positions that Derrick is currently holding as of just about 2 minutes ago. So just for disclosure purposes, since he is a professional trader, a registered trader, these are the positions that Derrick is currently holding. All right, Derrick. So happy Monday. How
Happy
is
Monday.
your day going so far today?
So far, so good. Coming into today after such a big bounce off the low from a week ago, the market is both in what I consider to be more of a technical equilibrium area. At the same time, positioning has gotten a lot more neutral. So the market here is very neutral, broadly speaking. So I kind of came into today with a thought process that I was explaining to my team in the morning meeting today, that this is going to be a less is more type of trading session. There is certainly more room for us to continue to bounce further, and that's actually my main expectation in the very short run is for us to bounce a little bit further, for us to push positioning up a little bit higher, the S&P and the NASDAQ a little bit higher, just to get everybody feeling maybe a false sense of security and calm, get people starting to be really upset if they didn't buy early last week, that they missed this major opportunity to be able to buy. And then as soon as you start to see people chasing in a little bit higher, then potentially we might see a little bit of a rug pull and get another lower high in the market. But obviously the CPI coming up on Wednesday is going to have a major impact on what we see going forward. So that's kind of where we're at. And right now until CPI, I think a less is more approach, being a little bit of a sniper, trying to manage a bit more of a hedged book is what makes sense.
When it comes to a week like this week where you have, that the midweek number, I guess tomorrow we get the PPI, so we get a little bit of inflation news tomorrow, and then we get the big number on Wednesday. Talk about how you strategize your own trading in a week like this, where you kind of having the lead up and you don't know what's going to happen. So how are you strategizing heading into that number on Wednesday?
Sure. So PPI will move the market, but CPI is the one that really tends to move the market in a very big way. We saw the last CPI print create a massive rotation where the IWM caught that huge bid and the Qs began their process of basically topping out. So this number is really important. What's unique about coming into the number this time around is that the market structure is so different than the market structure was for any of these other major prints this year. The big sell-off that we had last week, brought the VIX into the 60s. Even right now, as we're talking, we have a VIX trading, just below 20. So this is a different market than when we had, $15 billion of positive gamma and a VIX that was sitting at, 12, 13, 14. So we even saw a little bit, I think Thursday of last week, we had the unemployment claims number come out, which isn't the most important number in the world. And it came in just like a little bit better than expectations, yet the market had a rip on it. So right now, this market is very sensitive. It's really recovering from that VIX spike, from this mini market crash that we had on Monday. And these types of numbers that we have ahead of us, PPI, especially CPI, I don't think we have retail sales on Thursday, can and probably will be much more market moving than they would be otherwise, just because now we're trading at zero to negative gamma, and liquidity, top of book liquidity is lower than it's been at any point since 2022. So gear up, fasten your seatbelts. Right now we're a little bit slow and choppy, but this week probably has a lot in store for us.
When we coming off of last week, you and I talked last Monday about the possibility of the drop in all stocks, but really centered in those major tech stocks, having an effect of maybe helping to more balance the trade across the market. Do you feel like things are position-wise more balanced across market wide, or are we still just really concentrated in those tech names?
Sure. So the higher the VIX and the lower the gamma in the market, generally the higher the correlations are going to be. So we were in an environment that was really unique for a while in most of this year, but it seemed like it was especially that way in June and the beginning of July, where the NASDAQ and like the Mag 7 stocks were basically trading inverse to everything else. So if you would see the NASDAQ tick up, you would oftentimes see the IWM, the Russell 2000, your small caps and your mid caps tick down at the same time. And when you have heavy positive gamma and a very low VIX, that enables this dispersion trade where there's winners and losers and the S&P doesn't do as much. When the VIX explodes like it did, and gamma comes down the way that it did, then your correlations increase. So even right now, today we have some relative strength in the NASDAQ compared to the IWM, and I would say at the end of last week we did as well. But it's not like these indexes are trading completely inversely to each other as they were prior to this crash setup coming into play last week, and even really starting a little bit the week before that.
Mm-hmm. For everyone who is with us live, if you have any questions for Derrick specifically, make sure to get those in here early on so we can make sure to answer all of them. We've gotten some hello comments from YouTube, but no questions so far. What's up,
Nice.
Derrick?
Hello, everyone. And if you want me to add on to that a little bit,
yeah.
The market has to go through a healing process after what happened on Monday last week. I was looking at a bunch of statistics last week and then further over the weekend. Last week was the 6th biggest and fastest equity outflow from the market that's ever happened over the course of my career. It's in line with or slightly less than, there was like a double dip recession fear in 2010. That was the beginning of my career. The COVID crash, the yuan implosion on August 24th, 2015. I remember that day very, very well. And the Volmageddon, COVID, all those situations. This was like the 6th biggest one over the course of my career. You don't just get an explosion to VIX 65 or whatever that number was, and the Japanese market having its biggest down day since 1987, and then 3 days later everything's okay. It takes a lot of time for the market to kind of regain its composure, for people to feel comfortable having more risk on in the market. So we're just still very much in a market right now where you're going to continue to see a lot of really big intraday movements, especially compared to what we were seeing in like June as an example. And this is definitely an if-then statement, if we can get through the next couple of weeks without another event creating some sort of big crash or anything like that, then slowly this market can begin to heal itself a little bit. Slowly the intraday ranges can compress a little bit. Potentially that underlying bid comes back into the market. So we'll see if we can get through these next couple of weeks unscathed, and we'll see if that creates a little bit more of a bullish setup. I still have some concern in the back of my head. I think it's okay to be tactically bullish. I turned very tactically bullish Monday last week for the move that we experienced last week and that we're still seeing a little bit of in the beginning of this week. But I think it's hard right now to be very big picture bullish until we can, at a minimum, get through the next couple weeks, but probably more likely to get through the next couple of months, just because we still have some weak seasonality for August, September, and then that weak seasonality in election years oftentimes extends through October into the election period. So let's at least get through these next couple of weeks and we can see if this market can actually settle down or not. And then otherwise, it's hard, I think, to be big picture bullish until we get through the election, until we get into November. And then that's so far away that, let's take it one step at a time, but then potentially into the end of the year, that November, December period tends to be pretty bullish. Buybacks, lots of money flows in at the end of the year. So we'll see how it all plays out.
For many traders, last week was one of their best with the volatility that was happening. We had big days up and down. We could open up in the morning, close down in the afternoon, big swings. How was the week for you looking back as a trader? What were maybe some of the best trades you had last week? Let's do a little review.
Sure. So last week was insane. To give myself a pat on the back for it, on Monday morning, I opened up with more negative P&L. I opened up down more than I've ever been at any point in my entire career, probably a multiple of any amount that I've ever been over the course of my entire career. Yet I was able to finish the week positive. So for me, that is about as good of a job as you can possibly get. If you're down the amount of money that I was to then finish the week positive, I mean, that's where it's at. And the ultimate call was still Monday morning of last week, which I know you and I discussed midday on Monday last week. I was very distracted because markets were moving so fast. I was managing so many positions at the same time, even as like I am now, but markets are obviously a little bit slower than when we spoke a week ago. But the ultimate call, and one of the better calls that I've had, because I felt like I really said it with conviction, was specifically on Monday morning, telling everybody in the morning meeting that day, we have to be buyers today. We have to be buyers. Normally, that's not how I roll. Normally, I don't like to tell people that they should buy or sell. Normally, I like to kind of work with them on the strategy that enables them to make their own decisions based on the edge that they've developed that tell them how they can buy or sell. And Monday of last week was a different situation. It was, look, in this degree of downside extension, in this degree of panic, from my experience, this is a must buy. And then within 5 minutes of the open, I remember we had that quick downside tail forming in the Qs. That was the signal. Press the buy button. Give me long versus lows. The risk reward was just phenomenal. And I would say it was, one of the better career calls that I've had. And then the rest of the week was just about managing that setup and getting the follow through. I mean, there were still more opportunities to buy. I remember Tuesday morning saying that you can still buy financials. There were still more opportunities to be able to capture that upwave. But that call Monday morning, I really think that for most traders, like I started as a day trader, but I'm definitely not exclusively a day trader anymore, even though I do still day trade. I swing trade. I'm often managing, 20 to 35 positions at a time. I have found as my career has advanced and I'm doing more swing trading over the years, that a lot of the times it's the really good decisions that you make at really important moments that set you up to get paid for days or even potentially weeks going forward after that. It was that way with the call at the end of October in 23. It was that way with the call on Monday of last week through today. I'm not as bullish as I was at the end of 23 as I am now. You set yourself up on those really important days just to continue to get paid for days to come. And that's what it was about last week.
All right, we do have a question from YouTube. It's from Brant. Brant, I believe from the Pro Desk. He said, do you think the rotation that was happening a few weeks ago from big tech to some other sectors can reestablish itself and or continue, or was just a short-term repositioning that's over?
I think it can reestablish itself if the VIX comes down. That's what's needed to lower market-wide correlations again. We need the VIX to come down. So that's one of the biggest things I'm just paying attention to right now is what is the VIX doing? We're watching it like constantly as a team on the Pro Desk because it's so important, not just for the near-term market movement right now, but it's also important to figure out what type of trade we should be focused on. Because I think that a VIX of plus 20 or VVIX continuing to be above $100 means that it's going to be really hard to get big moves on the rotation trade. And again, everything right now, even as I'm talking, sure, there's some QQQ relative strength today, but for the most part, things are trading together in a much bigger way than they had been in June. I think that those correlations will decrease if we can really start seeing the VIX hold below 20 throughout this week / next week. And then all the vol selling just comes into the market that just drives that lower. And it's the vol selling coming into the market that then increases the positive SPX gamma that enables the constant rotation trades to happen. So that's why I'm saying we're in a healing process right now for the market. And it's a matter of time. And the more time that goes by, every hour, every day that goes by, that we don't get a major event that moves the market in a big way, whether that event is stemming from geopolitical reasons or that event is a big surprise in one direction or the other with the IWM, every day that we can go by where there's not a huge event that increases the VIX through the roof again, we get closer and closer to getting through that healing process that can enable the rotation trade to come back on. But it's not here yet, obviously.
In addition to the PPI, the CPI retail sales this week, we are getting kind of the trickle in, the start of retail sector earnings. We're going to get Home Depot's numbers tomorrow morning, Walmart's numbers on Thursday. Two really important numbers for that sector. Do you have any thoughts ahead of retail earnings this season?
Not really, to be totally honest with you. It's not a sector or names that I overly trade. Though obviously, Home Depot is, as an example, is important to the economy as a whole. So I'll pay attention to the earnings report when it comes out, but it's not something I pay attention to too much. If I had to pick, I'd rather be bullish on those companies than bearish, especially as interest rates continue to decline, and maybe that leads to the housing market getting a little bit more activity, which then potentially leads to just more people wanting to go to Home Depot because they want to change the coat of paint on the house that they just purchased. So I think that maybe as interest rates come down, we can see housing activity pick up, and then maybe that's good for Home Depot going forward. And obviously what moves stocks generally is expectations that they establish for the future. So if they can give good guidance, if they expect their business to pick up a little bit for whatever the reason is, then obviously we'll see an uptick in the stock.
Mm-hmm. All right, Sam from YouTube wants to know if you think the Fed is behind the curve on cutting rates.
Yes, I do. Now, with that said, I also said last week when I met with Greta, and I'll stand by this as well, that the people who came out of nowhere on Monday, like Bill Ackman, who were calling for, who obviously has a tremendous amount of success, so I'm not overly downing him. But the people who came out of nowhere on Monday who are like, we need a 75 basis point emergency cut right now, plus an additional 75 basis points in September. Like those guys need to go do some meditation or something. Like you got it. That's just not how the Fed works. So I think that the Fed is a little bit behind the 8 ball. I think that they will give us a cut in September. I'm still leaning towards it being 25 basis points, which I know the market is increasingly priced in a 50 basis point cut for September. I think we saw that number drop a little bit this morning to like a 44% chance of a 50 basis point cut in September. I forget exactly what the number was, but I think that they're going to cut by 25 basis points. That's what I think they're going to do. Now, again, the question was directed towards me on do I think that they're behind? I do, but my reasoning for it is a little bit different than probably the way that the Fed is thinking. My reasoning for it is I don't think that this increase in interest rates has done very much to battle inflation at all. And as a matter of fact, for certain segments of the population and for certain companies out there, I think it's even had the opposite effect. It's really creating haves and have-nots in our economy, and it's not a good thing. And it's the reason why they need to cut. And I can get into it briefly. So think about it. If you have a mortgage that's locked in at 3% from the COVID crisis era, or if you've had a mortgage even for longer than that, but you were able to refinance down to 3%, you're locked in at that. And if you've got a 3% mortgage and you're locked in at that, and you're a person who has a job and brings in income and generally does well for themselves, you can have your money literally sitting in a bank account and getting 5% right now. You're paying 3% on your mortgage. You're getting 5% on your cash. That's inflationary. You can take all that extra money, you can take the spread between that, and you can just go out and you can spend and you can spend and you can spend. And that's the same thing with certain corporations, your Apples and your Microsofts of the world, who have more cash on hand than they can ever really know what to do with. That's why their stock buybacks are so big. That's why they're spending so much money on these outlier projects like AI or the metaverse or whatever. Those companies are just fine. It doesn't really matter to them if interest rates are higher or lower. The people who are getting hurt right now are young people in their 20s who want to go buy their first home, who want to engage in household formation. The people that are getting hurt right now are the small cap companies that need to be able to raise additional capital for their ongoing activities. So, it's just a really bad position that they're in. Like imagine trying to go buy your first home right now in this environment because you just got married and your first kid's coming along the way. It's really bad for them. So what I think, and the main reason why I think the Fed's making a mistake and why they need to get started with their cutting, is because the raising of interest rates, and it's probably because of where we started from to begin with, starting at zero, really hasn't done very much at all, in my opinion, to actually lower inflation. The lowering of inflation, a lot of that is still coming from supply chain economics slowly coming back together in a post-COVID crisis that is a multi-year process to get there. And if you can cut rates, then the haves, the 3% mortgage people who are getting 5% on their cash, aren't going to feel as comfortable spending at the same rate. And the have-nots can get a sigh of relief where they say, oh man, maybe I can actually go and buy a house. So I think that the Fed needs to cut. They need to start as soon as possible. But I also just don't think that these are the type of people who are going to freak out because the market dropped 4% in a day or whatever and do 75 basis point cuts. But obviously, let's see what happens with these numbers this week.
Mm-hmm. All right, Joe T from YouTube has a counterpoint for you on rates and housing, saying, wouldn't that increase prices of houses if demand goes up?
Potentially. This is a big question that I'm curious about because, if rates go down, then it should increase the demand for houses, right? I think that's in line with the question. If rates go down, then all of a sudden you can, afford your house in a better way so that demand goes up. The question is that I don't have the answer to, and time will tell, is can it also increase supply? Because the flip side is, in the same way that there are people who are probably sitting on the sidelines who want to buy a house, and I would still argue that if you need to buy a house, you're still just doing it because you need to. But in the same way that there's people on the sidelines who maybe are waiting for interest rates to come down in order to buy a house, there's probably also people sitting on the sidelines who are waiting for interest rates to come down so that they can sell their house. And that's because, let's say you want to upgrade to a bigger home or something like that, but you have a 3% mortgage on your smaller home. You feel like you can't leave that house. You can't leave that house and begin to go look for something else. Because why would you give up your 3% mortgage and take on an 8% mortgage? It just doesn't make any sense. But if we can see those interest rates come down a little bit, maybe at a certain point you say, okay, well, I've got child number 4 coming along the way here. I really need to upgrade my house. And now interest rates have come down where I can get a 4.5% mortgage or a 5% mortgage. I'm willing to now sell my house, which brings that supply in back online. And I'll give up my 3% mortgage because I know I can get a 4.5% or 5% mortgage. I'm not going to give up my 3% mortgage in order to get an 8% mortgage. So I'm really curious to see what happens with the housing environment as interest rates begin to come down. It's definitely a big question mark in my mind. It should increase demand, but can it also increase supply? We'll see. We'll see what happens.
One interesting thing that's happened with higher rates is there's been a larger increase of people, taking their investments, putting them in cash accounts, high yield savings accounts, things like that, because rates have been so high. As rates go down, would you expect to possibly see more inflows into the market as people are get back to saying, okay, well, it makes more sense to invest my money in the S&P 500 or an SPX targeted fund versus putting it into a cash savings account?
It's another one that's going to be really interesting to see because, the classroom style answer to that should be yes, right? Interest rates go down, so my risk-free rate is lower. So I'd rather take risk to be in equities to be able to get a higher potential return. And what that does to the market is it typically has an influence in the market's multiple. So in lower interest rates environments, typically the market trades at a higher multiple because more people are willing to have the risk of putting their money in the actual market. The interesting part about it is that we didn't really see, I don't think, over the course of 2022, 2023, as interest rates were going higher, the degree of equity selling and the degree of a reduction in the market's multiple that you would have expected as people were taking money out of the stock market to go into cash. And because we didn't see that happen on that side of it, will we see it happen on the other side? And I'm not sure. Again, very straightforward. It should be simple. Interest rates go down. 25 basis points probably doesn't do it, but you start seeing multiple cuts over the course of a year period of time or whatever, then more people should be interested in the stock market. But it didn't really work that way the other way. So it's another one of those things where sometimes the classroom answer is a little bit different than what actually happens in practice. And there are so many things about how this market, and by this market, I don't even mean just equities. I mean equities, bonds, interest rates. There were so many unique situations on how this market played out resulting from the COVID era situation that we have just never seen before in the history of markets. So that's why we're seeing some of these traditional classroom style thought processes not work out in the same market environment. I mean, you can even just look at the yield curve inversion, which up until this time was 100% success rate in calling recessions. And this time around, well, there's no such things as 100% in trading or in markets, is what I always like to say.
All right, as we head into this CPI week, if you could talk through maybe with some charts, what are some of the setups that you are eyeing, looking at? You might not trade them, but they look good, etc.
So the biggest thing for me is really the macro right now. I am more focused on the indexes than I have been in a very long time, because correlations have increased. If you can nail the indexes, you can probably nail the stocks. You cannot trade right now with a blind eye towards how the indexes are trading, because everything is moving in line with the indexes. So for me, it's like I said, as this market has worked its way higher last week through today, through probably tomorrow, as the market works its way higher, I have been using that as an opportunity to lower risk. I've been selling out longs on the way up. I've been selling out longs that were purchased last Monday, and I've been building in hedges for myself. I've got the Q short. I've got some IWM exposure on the short side. So as the market has snapped back into technical neutral territory and positioning neutral territory, I also want to be a little bit more neutral, because where we're at right now is really highly uncertain as far as what the next steps are. And usually I've got a pretty good feel, I think, and usually a pretty accurate feel on what that next step of the market is in terms of higher or lower. And there's just such mixed information out there. And the bottom line is that so much of it is neutral and so much of it is data dependent on these numbers, that I want to come into the CPI Wednesday a little bit more neutral than I have been at other times in the past, especially with where the indexes have gotten to now.
All right, Sam from YouTube wants to know what you think about NQ. Do you trade it?
So I just had him short the Qs. I don't trade futures. I trade equities and ETFs and a little bit of options, but QQQ, NQ, it's the exact same thing. You're trading the futures product, I'm trading the ETF. I can get into the reasons why I think trading the ETF is better than trading the futures product, but if you want, you can just email me about that. We can talk about it.
Give us your little brief thought on it.
Sure. Well, I mean, for me, it's because I have the prop trader advantage is really what it comes down to. I'm a prop trader with T3. Most people who trade futures, especially if they're more on the retail side, they trade futures because of the leverage that they're able to get from trading futures that they can't get on stocks. For me, because I trade on the prop side with T3 Trading Group, T3 Trading Group will give me all the capital access, all the buying power that I could really ever want. So given that then negates the benefit of the trading futures for leverage. My thought process has always been, why would I want to trade futures? Because then I'm just locked into a few products. The people who trade futures, they trade the S&P, they trade the NASDAQ, they trade the Dow, maybe they trade a couple commodities, and that's it. Sometimes I wake up and I look at the S&P and I say to myself, kind of like this morning, to be honest, I don't have a strong advantage here. And if I don't have a strong advantage, why do I want to trade the S&P? Well, you might end up trading the S&P anyway, because it's the only thing that you have access to, or one of just a few things that you have access to. And the hardest thing for a trader is to not trade. But for me, I can look at the S&P and say, wow, I don't have a strong advantage here. But guess what? I've got access to 10,000 companies, and these 10 got upgraded and these 5 had an earnings report, and I can dissect the technicals of those individual stocks in combination with the news and still be able to find opportunity for myself. So that's why I'm on the equity ETF side and I'm not on the future side. If anybody wants to learn about trading prop with T3 Trading Group, they can reach out to me and I'm happy to explain it in more detail. But yeah, I am trading I trade the S&P, I trade the NASDAQ, I trade the Russell, I have positions in the Russell, I have positions in the NASDAQ. I also have positions in like 20 additional stocks right now on top of that. I'm in 24 positions total as we're having this conversation. Was that the extent of the question? You just asked me if I trade it?
Okay. Yeah, what you thought about it and if you trade it. Mm-hmm. Yep. All right. Well, I think we can let you get back to trading. Your little spiel on prop was good there, actually, for our lead into here. You can get Derrick's free ebook, t3live.com/DO-live. It is an ebook about prop trading, the benefits of prop trading, all of those things. So go ahead to t3live.com/DO-live to get that. Derrick, good luck this week. Lots of catalysts coming. So a slow day today, but hopefully things will pick up for you and the rest of the pro desk throughout the week. And I'll see you back here in a week. Have a great trading day.
Thanks, Greta. Appreciate it.